The number of container ships has dropped by 47%, and shipping costs from China have surged by 300% in just 10 days, directly impacting production and the distribution of goods. China halts Boeing deliveries, and U.S. ports face congestion. In April 2025, China halted Boeing deliveries, causing Boeing to lose $28.4 billion in just 48 hours. This wasn't only an economic decision, but a strategic move in response to new U.S. tariffs. Boeing, once a symbol of U.S. industry, is now a target in the trade war. This decision has led to the cancellation of several billion-dollar contracts and disrupted Boeing's production plans for the second half of 2025. Simultaneously, U.S. ports are grappling with severe congestion. The number of container ships has plummeted by 47%, and shipping costs from China have skyrocketed by 300% in just 10 days. The delay in contracts from Chinese shipping companies has caused a backlog of goods, especially in industries relying on Chinese components to maintain production. Amazon, one of the most affected companies, had to cancel over $67 million worth of orders. This is a massive shock to the U.S. consumer market, as products can't arrive on time, causing stock prices of many retail companies to plummet. The direct consequence? U.S. companies are facing severe supply chain disruptions, reducing production capacity, causing shortages of essential items, and driving inflation higher. Impact on the automotive industry and structural changes. The U.S. automotive industry cannot escape the crisis. Ford and GM have been forced to halt production of several vehicle models due to a shortage of key components such as microcontrollers and electronic parts. This has halted production lines, preventing the completion of many popular vehicles. This prolonged situation has caused car prices to rise dramatically. For example, the Ford Mustang Mach-E and Stellantis models saw a 6.8% price increase within just 1 week, an unprecedented surge in the automotive industry. In response to the disruption, Tesla has shifted Model 3 production to Berlin to reduce reliance on Chinese imports. Meanwhile, Toyota is adjusting its hybrid models to decrease dependence on semiconductors and parts from China. However, this is not a quick fix. The shift in supply chains has increased both the cost and development time of vehicles, resulting in higher car prices and longer delivery times. Moreover, China has restricted exports of rare materials such as dysprosium and terbium, crucial for the production of batteries and military equipment. This presents a significant challenge for the U.S. automotive and defense industries. Companies like Lockheed Martin and Ford are facing shortages of essential materials, and finding alternative sources from Australia or Canada will take at least until 2026 to be effective. Meanwhile, this shortage not only disrupts production, but also forces companies to compete fiercely for alternative supplies, driving up production costs and creating a large gap in the global supply chain. Production and global competition. While Tesla and other companies try to shift production, Rivian, Ford, and Chevrolet are ramping up competition with new electric vehicle models. However, rising component costs and longer delivery times have caused car prices in the U.S. to soar. Companies are facing reduced profits and a shortage of vehicles due to production disruptions. Issues ranging from supply chains to material shortages are forcing the global automotive industry to adapt quickly. Tesla and its competitors continue to search for partners to replace China. However, this process is far from simple and will take a long time. Can these changes help companies retain market share while minimizing the impact on consumers? The answer remains uncertain, but the emerging challenges are becoming increasingly clear.